So let's dig into the latest quarterly report from lithium producer Elevra. And honestly, at first glance, it tells a pretty confusing story. A story of incredible success, but also some, major operational stumbles. We're going to deconstruct these results and really get to the bottom of what's going on. Let's get into it.
Right off the bat, this is the number that just jumps off the page, $66 million US. That's a record quarterly revenue from their main operation, the North American Lithium Mine, or NAL. I mean, it is a huge number, a massive 223% jump from the last quarter. So far, so good, right? Everything looks great.
But this is where things get a little weird. While that revenue was just shooting for the moon, the actual amount of lithium they produced, well, that fell by 15%. So how does that even happen? How do you make way more money while actually making less of your product? That's the big mystery we're going to solve here.
Here's how we're going to break it all down. First, we'll look at this quarter of contrasts. Then we'll get into the trouble at the mine. After that, we're following the money to see how the numbers worked. We'll explore their path to recovery, and finally, we'll look at how they're building the future.
Okay, so let's start with this whole idea of a quarter just filled with contradictions. Honestly, this is the key to understanding the entire story.
I mean, just look at this. It really lays out the puzzle perfectly. On the left, everything's going up. They mined 15% more rock, they sold a wild 154% more product, and they got 27% higher prices for it. Boom, that's your huge revenue jump. But then you look at the right, and they actually produced 15% less of the final product, their efficiency dropped, and their cash on hand even went down. It just shows this huge disconnect between what they were digging, what they were processing, and the final financial result.
Okay, so to solve this puzzle, you've got to go right to the source. Let's head to the mine itself and figure out what caused that big drop in production. And this is it, the North American Lithium operation up in Quebec, Canada. You can think of this place as Elevra's engine room, and it's right here where all the operational challenges from this quarter really played out. Whatever happened here sent ripples through the entire company report.
Now, before we get into the nitty-gritty, we need to understand a really key term, lithium recovery. It's basically just a measure of efficiency. You mine a ton of rock, and the recovery is the percentage of actual lithium you can get out of it. And that analogy is perfect. It's all about how much juice you can squeeze from an orange. And this quarter, well, they squeezed about 7% less juice.
So why less juice? Well, it turns out it all came down to a few things. They were mining in a really tricky part of the pit, right near some old underground tunnels. The ore they pulled out here just had a lower grade, less of the good stuff, the lithium, and it had a higher iron content, which is the bad stuff. That iron basically clogs up the processing works, and that makes it harder to get the lithium out. So bottom line, geology was the bad guy this quarter. Okay, so production was down because of some tricky geology. That explains one half of our puzzle. Now let's follow the money to understand the other half, that record-breaking revenue. Right, the financial story, it's a lot simpler and frankly, a lot happier. It was kind of like a perfect storm, but in a good way. You can see it on the chart. Two huge things drove that revenue. First, they cranked up their sales volume by over 150%. They probably did that by selling off material they already had stockpiled. And second, the market was totally on their side. The average price for lithium jumped 27%. So, you sell a lot more stuff at a much higher price, well, that equals incredible revenue. And check this out. Here's another really critical piece of the financial puzzle. Even with all those challenges at the mine, their unit operating costs, what it cost them to make and sell each ton, stayed remarkably stable at $812. That shows some really strong cost control, even when things weren't going smoothly. Management's own words really sum it up perfectly. They admitted there were challenges, but they hammered home the robust financial performance. They pointed out that this quarter really proved they can cash in when the lithium market is hot. Basically, they're telling investors, hey, even with some bumps in the road, our business model flat out works. So we get the problem, and we get the financial upside. But what really matters now is what's the solution. So let's take a look at their path to recovery. The company has laid out a really clear, super practical, three-step plan. They're going to do more grade control drilling. Think of it like making a more detailed geological map so they know exactly what they're digging into. With that info, they can get better at blending different ores to make a more stable mix for the processing plant. And finally, they're just going to get smarter with their mine scheduling to work around those tough spots. And this is absolutely crucial. Management has been super clear about this. They see this whole thing as a temporary, localized problem.
They've gone on record saying that this difficult ore is not what the rest of the mine looks like. They're basically saying, look, we just have to get through this tough patch, but it is just a patch.
And to prove they're serious, they've actually changed their forecast for the whole year. You can see here they've lowered their production and sales targets, and they've bumped up their cost estimates a little bit. This is a good move. It shows they're being transparent and are managing everyone's expectations while they get these fixes in place.
Okay, finally, I think it's really important to zoom out from the challenges of just one quarter at just one mine and look at the company's much bigger long-term picture. So while they're fixing these short-term problems in Canada, they're also pushing ahead on this massive global portfolio of projects. We're talking new developments from Ghana all the way to the United States. This kind of diversification is absolutely key to their long-term goal of becoming a major global player. So here's the key takeaway. Elevra is essentially playing a two-level game. On one level, they are laser-focused on the day-to-day, managing these tricky geological challenges. But on another level, they are building out this global pipeline of projects that's designed to make them a huge name in lithium for decades to come. Ultimately, this whole quarter was a fascinating look into the realities of mining. Sometimes the Earth itself just throws you a curveball. What we're seeing is a company navigating the messy, short-term problems of geology, all in the service of powering our long-term battery future. So the big question is, will this two-pronged strategy, fixing the present while building the future, actually pay off?